Hi everyone. So the policy rates have been increased by RBI. Everyone knows that. What we are going to discuss is the implications of the hike in policy rates. That's very important for our examination purposes and also for your general awareness. Before going to the implications, it's important that we understand briefly what exactly are policy rates. There are two major rates that are considered a part of policy rates that RBI has complete control over. Reverse repo rate as well as repo rate. Repo rate is repurchase agreement. That is what it stands for. And reverse repo rate is reverse repurchase agreement. For one, the name of reverse repo has been changed to standing deposit facility, SDF. Okay. Now the difference between reverse repo and standing deposit facility is that now no collateral will be required for a standing deposit facility. Don't worry, I'll be talking about the meaning of no collateral as well. So what exactly happens in a repo? What is the purpose of a repo rate? This is the rate at which banks can borrow from RBI. So if a bank wants to borrow money, it is short on cash, it can borrow from RBI for an overnight basis based on an interest rate called as repo rate. It is a repurchase agreement by which we mean that RBI gives money to the bank with a promise from the bank that the bank will give back the money in the future based upon the agreement, and whatever days are involved in between in the transaction, for those number of days an interest will be paid by the bank. Okay. Now bank, for borrowing money, also has to provide a collateral for the same amount of value to the RBI. This is called as collateral. So if a bank borrows, let's say 100 rupees, then bonds or government securities or anything else worth 100 rupees has to be kept with RBI. When the deal expires, then the RBI gives back that security and the bank gives back the money that it had borrowed along with interest. In a standing deposit facility, which is the new name of reverse repo rate, there will be no collateral. So the bank can deposit money with RBI because it's a reverse repo, but the RBI will not be required to give any collateral to the bank. That is what has changed. Now let's come to the implications of change in policy rates. So what has happened in the policy rates is they have increased. The RBI has increased two major rates. One is repo rate. Reverse repo rate increases with the repo rate. And secondly, they've increased the CRR, cash reserve ratio. What are the implications on banks? When the repo rate goes up, that means the rate at which banks can borrow from RBI goes up. This means that the cost of borrowing for banks is more. When the cost of borrowing of the bank is more, then whatever it lends to the people in the future or corporations, the rate of interest on that will also increase. Let's say you borrow money on 5% interest and you want to lend that money to me. Now, because your cost is 5% on that loan that you've taken, you are not going to lend that money to me at less than 5%. Tomorrow, let's say your cost of borrowing increases from 5 to 7%. Now you will not give that loan to me at less than 7%. So my cost of borrowing has also gone up. This is what happens. When the repo rate goes up, then the cost of borrowing for people go up in the market because the cost of borrowing for the banks has gone up. What this does is it incentivizes or pushes people or forces people to lessen or reduce their borrowing requirements. Now the borrowing has become expensive. So instead of borrowing at, let's say 10%, I will say, okay, let me hold it on for a minute. It's too expensive. I'll probably borrow after a year. So this reduces investments in the economy. This reduces borrowing in the economy. As borrowing reduces, investments reduce. Then what happens? The supply of money in the economy goes down. When the supply of money in the economy goes down, then inflation also goes down, because more supply, more money in the economy, less value of money in the economy, more inflation in the economy. Okay. So this is the entire sequence of how a rise in policy rates affect the borrowing in the economy and the supply of money in the economy. It has another implication. The savings increase, the FDs increase, and the deposits of people with the banks tend to increase. Now, why does this happen? On the one hand, the cost of borrowing for the bank has gone up because the interest rate for the bank has gone up in the form of repo rate. At the same time, the supply of money is started to go down. When the supply of money goes down, then the bank is expected to have less liquidity. Now, the bank has less liquidity in its hand, but it wants to keep lending. For that, it has to keep borrowing from some or the other place. It wants to not borrow everything from RBI. It has to borrow at long term also, or at a lesser rate also from elsewhere. But people are not lending anymore to the bank, because the interest rates are too less and supply of money is already reducing in the market. So what do banks do? It's a pure game of supply and demand of money. Because banks need money, liquidity is going down in the hands of the bank. Banks start to increase the rates that it offers on its deposits. So the FD rates, if they are at 5% now, they might increase to 5.5%. If the savings rate, if it is let's say 3% now, they might increase to let's say 4%, so on and so forth. As the banks start to increase the rates that it offers on the deposits that people make to the bank, people start depositing more money with the bank. Okay, because inflation is already high, they don't want to consume everything. They want to save also, but at the same time the rates were too low, so they were consuming or saving elsewhere, putting it in stock markets or something else. Now the rates start increasing in the banks and people say, okay, let me put the additional money that I have with the banks only, the rates have gone up. That is how the banks try to attract more people to deposit money with itself, because the supply of money has gone down, liquidity has gone down in the economy and with the bank as well. So the implications are, number one, the cost of borrowing for the banks goes up, therefore the lending rate for the bank goes up. Secondly, the deposit rates with the banks also tend to go up in the long run. Okay, it takes a little time, it does not go up immediately. Secondly, what has happened is the CRR has increased in the economy, cash reserve ratio. Now, this is the money that the banks have to reserve with the RBI. And on this money, the banks do not get any interest from the RBI, and they cannot even invest this money. It is like a cash that the bank has to keep with RBI. In case anything goes wrong, then the RBI wants to make sure that banks have enough liquidity with itself to pay off its lenders. Okay. So the banks have to keep certain cash with the RBI in the form of cash reserve ratio. Now this rate has also gone up, which means the banks are required to keep more money in terms of cash with the RBI, for which it will not get any interest rate. So it is a loss for banks. It is an increase in their cost of borrowing further. Okay, and the liquidity is also going down. The idea is to reduce money supply in the economy in the short run. That's the ultimate idea. Okay, as the cost of borrowing goes up, the liquidity of money goes down, the value of money increases, and as the value of money increases, what that means is that inflation is going down. So this was all about implications of hike in policy rate, which means repo and reverse repo, and what has happened to CRR, what is the new name of reverse repo as well. This was all for this lesson. I hope it was useful. I hope you were able to sort out the difference between the two and the implications especially of a hike in policy rate, that is reverse repo rate as well as repo rate. All the best guys. Bye bye.